Welcome back to Real Estate Mindset. And I really appreciate you guys joining me. Obviously, this is going to be absolutely bonkers, and the data is in and the data is live. And today, what we'll do is we'll do a market update. Obviously, we'll listen to Jerome Powell speak at his conference. We'll take a look at that live. But first, I want to go on record, guys, and basically just kind of put out there where I'm at with this whole housing market. And I've been really reflecting on this, kind of, just got really to the root of being completely genuine, completely transparent. And really, guys, ultimately what I believe is many, okay, not all, I understand not all, but many home buyers right now are being fooled into this warped idea and dream of home ownership. And I believe as this story continues to unfold, more and more people are going to start to realize just how propped up and broken the housing market is. And if you've been following along on my channel, you know why that is. Essentially, the housing market right now has not been built on fundamentals. And what I mean by that is the massive equity run-up between 2020 and 2022, that breaking of fundamentals essentially makes it to where these prices are not sustainable, especially when we look at things like unaffordability and we look at things like wage growth. Now, obviously, guys, as a result of the lack of sustainability, I think what we started to see basically last year around June of 2022 is when there's no more toxic, super red hot home buying to prop up the housing market starts to deflate, or rather starts to crash in prices. Okay, now we saw that happen again, the start around June of 2022. We got into this year around the end of February, and essentially we hit a brick wall. What was the brick wall? I believe it was $400 billion of quantitative easing. But here's the thing, you guys, that QE only kicked the can down the road a few months. What we're already seeing right now is basically what I'm saying is from this point forward, okay, on average, we're going to start seeing prices go down between now, okay, right now, and all the way to February of 2024. Now, what we're going to need to happen is we're going to need to break the seasonality around March of 2024. Now, how do we do that? And really ask yourself that question. How do we do that? We enter recession. Jerome Powell breaks the Fed put. If we enter recession next year, I can almost guarantee you we will break seasonality next year. And if we break seasonality next year, you guys, there's going to be a full-fledged price crash, and it's going to be really easy to see that. Now, as far as inventory, okay, as of right now, again, on average, between now and probably around the end of October, we're going to start seeing inventory continue to increase. Now, that increase after October and really up into October, in my opinion, is going to depend on two things primarily. Number one being unemployment. Number two being consumer defaults. The more unemployment, the more consumer defaults, more than likely, the more inventory we will get. So now the question, you guys, is what do you do with this information, right? Why am I even saying this? Why are we making these videos? Now, basically, two people that I'm predominantly talking to, basically buyers, potential future buyers on the sidelines that are priced out, okay? Or rather, they're either priced out or people on the sidelines that have bad credit and things like that. What do you do if you're forced on the sideline? It's really easy. Count your blessings. Consider yourself blessed. You dodged a bullet. You have time to improve, really create purchasing power. And how do you guys do that? Well, start with your credit. Your credit is extremely important. The most important thing when it comes to establishing or reestablishing your credit is to stop bad things from happening, right? Like derogatory information being laid on your credit cards, late payments, not paying utility bills that turn into collections, right? You got to stop the bad stuff from happening. And then after that, it's a good idea to play the credit card game. The reason revolving debt or credit cards is the only type of debt that has something called utilization ratio. The lower your utilization ratio, the better FICO score, credit score increase you will get for each trade line. Generally, the maximum utilization ratio, and I'll wrap this up, the maximum utilization ratio you want to have on your credit cards is 30%. But if it's me and I want to reestablish my credit and I'm buying a house, I'm just going to have it at like no percent. right? You don't want to charge it up. So credit is important, and you don't want to be drowning in debt. If you are drowning in debt, understand you probably want to get out of debt first. Maybe start with the account that either has the lowest balance or highest payment. Now, the second thing, if you're forced on the sidelines, start trying to figure out how you can save money. Many people can't save money right now because they're in debt. So maybe in order to save money, maybe you have to figure out how to get out of debt. And I also know people that put money aside before they even pay off certain debt, like 10% of your income and things of that nature. But the reality is, in order to save money, we really need to understand how we spend money. And I use an app called mint.com. Now, another thing, again, if you're on the sideline, this is an important one, probably the most important one, because this is what we will need to have if we go into recession. Income, okay? If you're on the sideline, understand this. It's really easy to show income for loans when you're on a W-2, when you're on hourly income, salary, and things like that. But when it really gets creative is when you have either a second job, self-employed, bonus, commission, or overtime. If you're on the sideline, you want to work as many of those things as possible because you need a 2-year history to use that qualifying income for a loan. So make sure you're working as much as possible. Again, bonus, commission, overtime, self-employment, or second job, 2-year history. Do it as much as possible. Now, here's the thing. If you're on the sideline like me and you've already done those things, okay, what do we do? What am I doing right now? The first thing, guys, a lot of people need to understand how the market cycles work. Okay. If you're on the sideline, understand how market cycles work. And the other thing, be grounded in goals. Okay. Our goals will keep us as unemotional as possible, but it will also keep us focused on what exactly we want in the housing market. And what I mean by goals is my goal to purchase a home. I know what I'm looking for. And because I know what I'm looking for, when I see it, I can get it. Because my channel is not about timing the market. It's about finding a great deal. Okay. So when I find that great deal, because I have my goals, I will buy it. I'm pre-qualified. Okay. I stay pre-qualified right now. But again, if you're on the sideline, you do have great purchasing power. Hold strong, increase your empowerment, and just keep doing what you're doing. Save money and keep watching. And for the love of all that's holy, okay, if you're stressed out, go on a walk, do something other than get stressed out and lose hope, all right? And I'm not talking about false hope. I'm talking about hard work hope. There's a difference, all right? So that's what I wanted to say on record. We're going to get into the market update, guys. Right now, we had some interesting developments happen that I think you guys are going to find intriguing. All right, let me get there and show you guys right now, starting with the 10-year treasury. Is my audio okay, guys? I never even said good morning. I'm sorry about that. I've been so focused, you guys. I wanted to present this data to you as quickly as possible, and then basically do it in a time frame to where we would make Jerome Powell live speech, obviously. But here's the 10-year. We're sitting at 3.887, basically around 4%. We're still not able to stay in 4%. It's still high, but this is what I want to show you. It's very intriguing. Now, again, obviously, we're watching the 10-year because it tracks closely mortgage interest rates, 30-year fixed rate mortgages, okay? Now, when we go to the mortgage rates here, Mortgage News Daily, we can see rates are still 7.04%. So even though that 10-year went down, let me refresh this actually. Let's see if it's updated. It has not been updated. So even though that dropped, mortgage rates are still over 7%. That's very intriguing. I think that's kind of maybe extinguishing that demand, right? Obviously, I think they broke demand. Now, let me show you guys what's also very interesting and really why we can't trust the market. Okay, this is CME Fed Watch. Now, what's interesting is not what's going to happen today. Okay, well, it's going to be interesting what happens today. It's pretty much probably going to be quarter basis point hike today, but look at what the market is now pricing in for September. For the first time that I can recall, they now are saying market is now, CME Fed Watch, 20% likelihood of a rate hike, 25 basis point rate hike now in September. That's pretty crazy. And also look at this. They're also now in November, we're back at 35%. So we dropped into 20%, but now the market's like, okay, we're unsure. So what and look at this real quick. Look at December. Same thing with December. Okay. December's almost higher than November now. December's at 33%. You guys see that right here? Very interesting. So obviously, this is probably going to change drastically depending on what Jerome Powell says. Now, the question is what happened? All right, what happened in the market to where? Because you guys have been following my lives, and I'm not sure how many more lives I'll do. Because real quick, guys, before we jump in, we have a little bit of time. I'm going to try to end this month strong with doing videos outside. I want to take a little bit of a break from the studio and really just meditate and be as like genuine and transparent as possible about what I think is going to happen next in the housing market, like trying to explain like the emotion and what to do next. So I'm going to try to do the outside videos to just get off of this data, my gosh. But what's interesting is the market started changing because this form right here, the 5-year break even, that we've been watching for a couple weeks skyrocketed upward. All right, very interesting. And then the question is why did this skyrocket upward? And that shot actually really high. That's a huge concern to the Federal Reserve. A lot of people are saying this skyrocketed upward because of the earnings. The earnings that have been coming out has been favorable. So now the expectation of inflation is higher. So in other words, you guys, that got a lot worse. That's very intriguing. And it almost hit like a new low. It almost broke the increase in trend. And then it was like, nah, boom, straight up. So on one hand, this is interesting. Okay, so think about what's happening. We still have, obviously, we still have inflation, okay? Because we look at shelter, we look at the housing market. We already know we have inflation. So they're battling inflation. And let me show you guys what that's doing. Okay, here's the M2. This updated, by the way. This updated yesterday, right? Yeah, July 25th. This is the M2 money supply. So they're burning money out of the economy. Federal Reserve is burning money out of the economy, and it's effective. It's working. The economy is losing money. Look at this. Now, this recently updated. We were right here, June 5th. We were right here when it updated. So, basically month over month, the M2 is down. All right. So you guys see that month over month, M2 is down. However, what worries me is a potential trend where it's a downward trajectory, because you can see this new low right here. Do you guys see that low right there? So we didn't hit that low right here. So that's what I'm worried about. I'm worried we won't go past this low in May 1st of 2023. We'll know that, unfortunately, in 1 month. They stopped updating this weekly, but regardless, it's working. If it's not being burnt down, again, it's not updated weekly anymore. If it's not being, burned away, it's certainly at the very least plateauing. But it's interesting to note we lost about 4% in the money supply, I believe, in about a year and a half, I believe. But again, month over month from the update, M2 is still down. Interesting, right? Now, look at this as well. Here is the Federal Reserve balance sheet. Here's the quantitative tightening. This is them burning money out. And here's the brick wall. Okay, so when you guys remember what I said, we hit a brick wall around the end of February, and basically seasonal buying came back in and propped up the housing market and the prices again. And pretty much, I'm pretty sure every one of you guys could acknowledge that if they wouldn't have done that, it would have been a financial crisis, right? The bank runs would have spiraled out of control. So they did it. They did what they did. But look, there's the wall. That's the wall we hit. But I want to reassure you guys, at least, thank goodness, we're under where we were when they put the wall up. Okay, so this is going down, the quantitative tightening. This is good. We want to see this. They're burning money on both ends. Now, this is crazy. Take a look. Okay, let's look first now, the yield curve inversions. A lot of people are like, Travis, when's the time to buy? That depends on you, like I just said, and it depends on your goals. And when you find that property in that home that fits those goals, right? And some people are not even at that spot yet. Some people can't even afford a house right now, and they're freaking out about this. But the reality is, again, there's multiple things that we can do right now, regardless of why we're on the sidelines. There's a lot of things we could do right now to increase our purchasing power. Look at this, guys. Here's the 10-year and the 3-month inversion. This is the historical precedence to wait. This is the chart that warns us of incoming pain. And I want to bring something to light right now. All right. I realized this, probably a few days ago. Now, I've been looking at this chart and waiting for it to reinvert. All right, because historically, looking at this chart, and here's the mistake, this chart only went back to 1982, but historically, that 3-month and that 10-year reinverts, you guys can see, and then we enter recession. You guys can see the recession is in that gray vertical line. So you guys see it inverted here, which means goes under that black line. It inverted here and then reinverted, recession. Same thing here. It inverted, reinverted, recession. Same thing here. Inverted, reinverted, recession. Okay. So the pattern is typically invert, reinvert, recession. All right. But here's the thing that I found interesting. When I saw this chart right here, I was like, wait a minute. What if we are in recession right now, but it's just the yield curve is not uninverted yet? Is there a historical precedence from that? Because this chart right here, this is industrial production. Again, it's just another indicator. It's another indicator of a recession. So for the first time in a long time, we have year-over-year decline in industrial production. The reason why that's so interesting is if we go back to the 1970s, 1974, when we had a decline in industrial production, it meant and showed we were already in recession. We were already in recession, not a warning that a recession was coming, but that we already were in recession. And that's going back to the 1970s, the 1980s, and also the 1990s. Although in the 1990s, the recession started before there was negative decline, but ultimately the recession led to decline. And also look at early 2000s. The recession started immediately when industrial production declined. Intriguing. Now, in 2008, the recession brought on additional, the recession
Without the ones like you working tirelessly to keep things running,
production, but it's still very, very interesting because right now, you guys. Okay, hold on 1 second. Let me pause this real quick. So they just announced it. I'm gonna go back to here. Okay, so this is warning us that we're already in recession. All right. First of all, that's what I'm trying to say. But again, remember the historical precedents. Don't the yield curves need to be uninverted to go into recession? And the answer to that is no. When we look at the 10-year and the 2-year, and we go back to the 70s and 80s, really the 80s recession, we can see that we went into recession while being inverted. All right. So want to just point out, we don't have to reinvert to enter recession. Same thing happened again, the 70s and 80s. And what was going on in the 70s and 80s, you guys? The inflation battle was going on in the 70s and 80s. So there's a possibility that we're actually in recession right now. It's intriguing to think about that. I mean, if the home buying, again, if that toxic home buying is not there, the appraisal gaps, the bidding wars, if that's not there, we already know the sustainability, there's a lack of sustainability. The housing market starts to deflate. We've continued to see that. And I'm talking deflate, okay? I'm talking about decrease in value, not a slowdown in value. Now, another thing, new homes. So new home, I love this data. New home data came out as well. And I've been waiting for this data. All right, so we're going to start with the median sales price for new homes. So what do you guys think? You guys think that it went up? Do you guys think it went down? This is basically an update for June. And June was what? The peak, essentially, of home buying season. Take a look at this data, y'all, right now. Okay, look at. So it updated and it went down. So median sales price went down again for new home construction. That is so important to see that because new construction leads resale. And you can see it here. Let me move my picture. Look at this. We can see these trends clearly with new homes. It's really difficult to see it, though, obviously, you guys. On resale, there's a huge lack of inventory with resale. There's a type of lock-in effect going. We understand these things, but we can see that lack of sustainability in new homes right there. You see that peak. You see it still going down. And the seasonality, listen, guys, 2 things I want you to pay attention to. It should be high in June. This should have gone up in June normally, right? But we had two things. Unbelievable buying incentives, okay, at the peak of home buying. So understand that unbelievable buying incentives in the peak of home buying could not sustain those prices. Do you guys see my point? It could not sustain those prices even with their magic tricks. Now look at this. New home supplies. Okay, this is pretty crazy. I saw Pac West. Oh my gosh, Pac West is crazy. All right, let me show you guys this real quick. Here's the monthly supply of new homes. This also updated, you guys. Guess what? It went up. It went up. See why I'm saying what I'm saying? All that happened. You guys, everyone's like, oh, he's wrong. He was wrong about everything. Dude, they kicked the can down the road for what, 4.5 months? That's what I was wrong about. I didn't know they were going to put that brick wall up $400 billion. But look at this. Monthly supply is going up for new homes. We're at 7.4 months. And you guys, they updated last month. They're changing this data. Last month was actually 7.2. So again, what did I say before we even started this analysis? Prices are starting to go down and inventory is starting to go up, and that will continue throughout the year, and it will continue into next year if we don't have that Fed put, if the Fed doesn't bail us out, essentially. You guys see what I'm saying? You guys comment below. Let me know what you think. I'm going to check in here, see what's going on with this live. I don't think we're live yet. It is what it is. But I mean, holy smokes, you guys. I mean, I really feel like people are getting, taken advantage of. And again, not all people, obviously. Like, for example, here's the live right here. I'm going to throw this up just so you guys know where we're headed. Just in case you came here only to listen to Jerome Powell. I know people are annoyed listening to me. But, you guys tell me what you think. Again, not all home buyers. There's very intelligent home buyers. One of them is Jeff M. I see you, Jeff, right there. Let me tell you why Jeff was smart. He set a goal. Jeff's goal, he wanted to find the home of his dreams. He refused, you guys, and I tried to convince him. I was like, Jeff, just move to a different area that's more affordable, that has more inventory. He's like, no, I grew up here. So Jeff's goal was to find the home of his dreams. And he found the home of his dreams, and he purchased that home without putting himself in a situation to where he couldn't afford it. And that's the thing, you guys. Okay, here we go. Let's put this on right now. So Jeff, props to you. I saw you. I'll shut up.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Ooh.
Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go. I suspect he'll avoid
Mr.
housing
Chairman, thank you.
questions directly and keep people calm so he can continue
I think a couple
quantitative
times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warrant it. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Well, sounds like the labor market's super important.
Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything, and we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think that's core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater. And that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity. And, that's the thing we really need to avoid and will avoid.
Again, guys, inflation expectations. Do you guys see how important that expectations are to him? That 5-year
At
break
this point,
even?
you say
Amazing.
the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. And what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
You guys, you
Shouldn't
just
assume
keep going
that
in circles.
every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
So it sounds like he's being a little bit passive, trying
Howard
to
Schneider with
maintain
Reuters.
quantitative tightening.
So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags. And by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. the first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract the mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit
Very
side,
soft.
I'm wondering if you saw
Very
anything in
dovish.
the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions. And that's what this SLOOS will say.
Ruger, he's got a book of answers, so he has a scripted response
Hi,
to
Chair
specific
Powell.
questions.
Nicole Siegel from the Washington Post.
That's
Thanks
why
for
it's the
taking our
same thing over and
questions.
over again.
Could you break down
Thank you,
the
brother.
reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing. And the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
And just
He's
to
being
follow
very
up,
passive,
do you think
guys.
that of those two
Market is
sources,
swinging.
the core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Very passive. So I think he's being passive
Thank you,
so
Chair.
he can
First, let me
continue to
compliment
do
your
what he's
tie,
doing. His
choice of
actions
tie.
are speaking loudly.
So thanks for taking my
Very
question. So the
dovish.
Beige Book, it said input cost pressures remain elevated for services firms, but ease notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so, what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So, wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
You guys watch the Fed Watch tool. You can see the market jump around, starting to price in additional rate hikes, jumping all around.
I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance on that. I'm saying
he does decent, guys.
We'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year. I don't think.
He repeats himself.
It would be
over and over.
Many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
He's keeping the market calm.
Part of Wall Street has become more confident
calmish.
that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of I think constructive diversity of opinion that helps us informs our deliberations, helps us make I hope better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say though that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
You guys, obviously, he's lying. He's essentially lying to everyone. The question you got to ask yourself is, why is he lying?
CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So
ask yourself, why is he lying? Well, we know why he's
Thank you,
lying.
Chair Powell. Jennifer
Keep people
Schonberger with
calm.
Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching, the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions, bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events.
Wow.
And it seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down. And that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous. and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee. And when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting. And it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
So, he's pretty much saying the
As
same
advisor
thing he
market
said
research
last month,
national. Thank you,
guys.
Chair Powell.
More work
Financial
to do.
conditions have been loosening at a fairly steady clip in recent weeks. The dollar, the stock market, etc. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right; it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing. And ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
Let's hear what he says here.
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels.
Things are
to more
okay or
normal
broken.
levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in ensuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing. Yes. And yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window.
The 10 years down 3 basis points.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance. Excuse me. And also
Housing market question.
That the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move?
Looking in his book.
Also, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
What? You gave us nothing.
Hi, Chair Powell.
Absolutely
Nancy
nothing.
Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off.
Good one.
Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now. Thanks very much.
Oh. And it looks like that is it. All righty. That is going to do it. Let me exit out of here. So let me know y'all's thoughts on all of that in the comments below. My overall thing is, we all know that he's lying. Looks like we'll go into the market real quick, but here's the thing. I hope you guys, I'm not saying that I hope that he's doing the right thing. Everyone knows he's lying. He's not talking about housing. It's the biggest asset class. And really what I saw is Jerome Powell that's trying to keep the market calm and appearing weak and appearing dovish. He's not answering very important questions about housing, very direct, very important questions about housing. So, what I hope he's doing is stringing us along, because he's still doing things in the background to tighten quantitative, tightening and things like that. But at first glance, my goodness, he was just reading out of a book, and we heard these same, almost verbatim, the same exact responses during the last press conference. But some of the things that he, that I liked that he was very firm on, and this is why I have this much faith. All right, I'm not saying that I think, again, this much faith that he's really just tricking us, stringing us along for as long as possible before we wake up. I hope so. But he was very adamant about staying in that 2%. Right, 2% inflation target, not the 2.1, 2.2. So, when they try to pressure him and push him into, a corner, at least he stayed fighting. At least he stayed on that. But how could anyone say that was helpful? It wasn't really helpful. Let's see what he did to the market. The CME was jumping all around during that entire speech. It was really funny watching that happen. Obviously, we had some stuff on that 10-year. I want to bring some comments up here in a minute. But let's look at the 10-year. So we started basically sideways on the 10-year before he started talking. So the 10-year dropped 3 basis points. So about 3 basis points. Got down to about 4 basis points. Let's see mortgage rates. This is not going to update yet. I doubt it will. It's not. Look at CME. All right. The CME adjusted, which I found pretty interesting. Let me take off this banner, you guys. I'm sorry. I'm going to hide that. All right, I'm going to go back to this. So this is interesting. They're now pricing in December, there's now a higher likelihood of a rate hike. So the market's reaction to this is now they're like, okay, we're going to price in a little bit more of a rate hike. But the interesting thing is this. They've increased the pricing in for September. And again, this is Jerome Powell being dovish. So ask yourself, if he was honest to us, I'm not giving him an excuse. I'm just saying, if he was honest to us, wouldn't that cause pandemony? And wouldn't pandemony cause them to lose control of what they're doing? I think the pandemony is going to come, but I'm hoping that he's prolonging that, right? So he's pushing the pandemony back until, he's ready to let it loose. I don't know, maybe not, but look at 22% now, next month rate hike. Very interesting. Also, what's interesting is here's November, but look at this. Okay, so this just changed. Okay, so December is still sitting at 28%. So seriously, man, this is crazy. It keeps changing. So the market is still basically the same almost the same as what it was before his speech. So it's almost like nothing happened. But again, we went over all these charts so that we understood that there's actually a lot happening right now in the background, because we know, and I did that because we obviously know that he's a little bit useless, and we kind of knew that he was going to go around in circles. Very good questions asked. It is what it is, guys. But that's what I'm hoping. Let me pull up some questions. Not a lot of change. Again, really the only change in the market, 3 basis point change in the 10-year, small adjustments on the Fed Watch tool, going up. So market a little bit more pricing in. Again, not much changes. Let me see the stock market. I'll show you guys if the stock market is maybe crashing. So, I mean, it started basically sideways. I mean, it's down, Dow's up slightly. I mean, it's just, he gets to continue on, right? He gets to continue on. I mean, he didn't freak anyone out. He basically just carefully navigated through that, speech and got through it. And some of you guys pointed out that he was obviously, it appears that he has a book in front of him and he turns to the book when a certain topic comes up and reads from that. And you guys understood that he was saying some of the same things over and over. And I think some of you guys brought up some really good questions. All right, let me throw some of this up here. Someone said, why is it not a single question about the yield curve inversion? I thought that was interesting. Let me pull this up. I can't use bad words. Okay, so BNR, that doesn't surprise me. Rates will not fall until the economy gets in line with reality and exists the delusional phase. So we see that happen all the time. I mean, there's no question that the consumer confidence and the sentiment spirals out of control. Something breaks, something bad happens. So it's no surprise that we're seeing this. It is what it is. Now, the Deep has a good one. Your read on this, Travis, is widely different from the vibe I'm getting. So, and that has to do with why Jerome Powell, I think the Deep, what you're saying is like, first of all, I'm hopeful, right? I don't know. Maybe Jerome Powell is completely useless. Maybe we're right about our read on Jerome Powell. He's useless. He's dovish. He's lying. But I'm still holding on the Deep. I'm still holding on to maybe he's lying to us because we need to be lied to. Think about it. I'm not saying that I want to be lied to, but think about maybe we need to be lied to. Think about it. I don't know, maybe, right? So RD rate cuts in 2023 is ruled out. It's kind of obvious. So yeah, I mean, it's pretty obvious unless what happens, RD, black swan. Something breaks, right? Something breaks, a black swan happens, they'll cut rates. I wonder what that's going to be, though. Or instead of cutting rates, what will they do? And that's the point I was trying to make. It's possible that back in March, when it appeared that he just like strengthened the Fed put, which is basically the Fed rescuing the economy, maybe he did that so he wouldn't have to cut rates. Think about it. I don't know, man. Why isn't anyone asking about the history of the inverted yield curves? I think maybe, a lot of people, a lot of consumers just don't understand how that works, So there it is, Moses. I mean, I try to explain, what I'm hopeful with Jerome. Here's the Deep again. Travis, brother, I need to meet Kevin video reaction because I know you share his outlook, but he's turned. I'm not sure what outlook exactly. 100%. Comic lover. Appreciate some of your comments. Appreciate Tony. Comic, just be respectful. You guys, obviously, I saw some of you guys have a difference of opinion, but both Comic and Tony, good, different perspective, but valid perspective. So he's telling Tony, do the math on mortgage payments for someone who bought a median priced home pre-February 2022. The payments are equal to what an average one-bedroom apartment costs today. So I think what he's saying is rent went up along with house prices. People are suffering. Shelter's expensive. I'm not sure though. Comment. I'm not sure why I saved that. Now I don't see why he is. Okay, I don't see what he says as lying. This is why I wanted to bring this one up. I don't see what he says as lying. He never gives a straight answer, but that's not the same as lying. Well, it's not being forthcoming, and it's manipulating. But Matt, maybe we need to be lied to. Maybe the longer that we stay in this quantitative tightening, the better odds that we have to not have to normalize the situation. People are trying to normalize this off the backs of the consumers. It is what it is. But you guys, here's where I want to end. Keep focused on your goals. Understand the housing market cycle. Again, if you're on the sidelines, you're forced on the sidelines, create purchasing power. We talk about this all the time. If you're on the sidelines because you're choosing to be on the sidelines, stay grounded in your goals. figure out what you want in this housing market. What type of house do you want to purchase? What type of payment? What area? And then understand the data. Stay locked in. I'm qualified. As soon as I find a house that I love with a great deal, y'all, I'm going to report back to you and I'm going to buy it. Maybe we should do the same. Maybe y'all should do the same thing, is my point, because we don't want to be purchasing based on fear. Never based on fear. And that's what we see a lot of what's happening right now. And I fear that the people that are purchasing in fear right now, again, this is after 2022, right? I really worry that these people, they're in for a rude awakening. And especially if they're young adults. A lot of young adults have never gone through this. I mean, I'm struggling to understand what's happening because I haven't been through the 70s and 80s cycle, the inflationary cycle. I went through the great financial collapse. There's similarities in all of these things. But the reality is, for me right now, what I'm saying, guys, is risk off. And as I'm having the situation with risk off, as I'm sitting on the sidelines, I'm going to increase my purchasing power. And I'm also going to increase my mindset. I'm going to remain at peace with my decision. I've learned to love my life the way it is. So I hope the best for you guys. Thank you for watching this. Look out for those, those outside videos. Let me know if you guys love those outside videos or not. That's how I'm going to try to finish this month. Absolutely appreciate you guys. Good luck out there. And if you're out there investing in real estate, you guys know I wish you luck and I hope you